one of the nice things about building our retirement nest egg is we only need to reach our goal once. Once we've reached our goal, then job number one becomes protecting that nest egg, which is why in today's video I want to share with you 3 tools that you can use to minimize and hopefully eliminate risk in your portfolio. Let's go for a walk and talk about these. And before I get into the tools, I need to share with you what the main risks are that retirees and people approaching retirement face that younger people don't have to worry so much about. And the first one of those 2 is what's called sequence of return risk. And that's essentially the risk that early in retirement, as you're taking money out and as your retirement nest egg is the largest, that the stock market does poorly. And now you're forced to take money out of your investment portfolio to meet your cash flow needs. You're forced to take money out of your investment accounts when the market is down. Many of us have heard of something called dollar cost averaging, where we put $1,000 a month into an account, and sometimes the market's up, sometimes the market's down. But as we're putting money in, the down market actually helps us. Well, now we're on the other side of that coin. Now we're on the side where the down market actually hurts us because we have to sell positions in order to meet our cash flow needs. So the people that are benefiting from dollar cost averaging are benefiting from people that are selling positions. And unfortunately, if we're not careful, that can be us. So that's the first risk. The second risk is what I call being a forced seller in a down market. So it's related to sequence of return risk, but there's many reasons somebody could be a forced seller in a down market. For retirees, the 2 main reasons is we need cash flows and the market's down and the only thing we have to sell are things that are down. So that's one driver, but candidly, a bigger one is people become forced sellers in a down market because of the emotional pain that takes place when the market's down. If we look at the great financial crisis, the market was down from peak to trough almost 60% by the S&P 500. That's a huge, huge number. So how do you protect yourself from that, right? Those are the 2 main risks: sequence of return and being a forced seller in a down market. So how do we protect ourselves from that? Well, the first thing I want you to do is think about what the gap is in your income needs. So thinking about how much money you need every month or every year in retirement, and that's going to change. Early in retirement, hopefully, you're spending a little bit more money at a time where you can enjoy different activities, because as we get older, it's harder to do certain things. So it's hard to transition from a saver to a spender, but I want you to do that. But I want you to have a budget, at least for the next 2 or 3 years, and say, this is what we think we're going to be spending in retirement. So that's how much cash flow that you're going to be spending. And the next step is thinking about where's that cash going to come from. For many of us, Social Security is going to represent anywhere from 1/3 to 80, some people 90% of the money that we're spending in retirement. So, some of that cash flow is going to come from Social Security. Some people have rental income. You might have investment income coming in. And then you also might have maybe a business that you invested in. But whatever the sources of income are, and other people will have a pension. So Social Security, pension, rental income, those tend to be the 3 most common. And so add up what those are, and then look at what your expenses are and say, what's the donut hole here? What's the gap that I need to come from my investments? Because that's where we need to be careful that cash flow that we need from our investments is going to be there, it's going to be predictable, and preferably it's not going to be subject to the market going up and down. So by order of riskiness, I'm going to give you 3 tools. The first tool is the riskiest of the 3. The next one's a little less risky, and then the third one's the least risky. So I'm just going to give you an example. Let's say you need $6,000 a month, and you say $3,000 is going to come from Social Security, and $1,000 is going to come from some rental properties that you have. So now, if I've done my math right, you need $3,000. That's going to be a month coming from your investment accounts. So one strategy you can do is you can look at dividend stocks. Now you have to be careful with dividend stocks because picking the right dividend stock can be really important. And basically what a dividend is it's money that companies give their investors. So for investments, there's the growth of the stock, right? The price appreciation. Hopefully you bought a company that over time goes up in value. And then some companies, in addition to investing in their future, they have excess cash flows that they share with their investors, and that's called the dividend. And you want companies that are providing a dividend because of their operational excellence, because the cash flow is coming from their operating business. You know, if they're a manufacturer, the cash flow is coming because they're making widgets and they're selling widgets, and this is excess cash flow. There's another category of dividend-paying stocks, which tend to be companies that are borrowing money in order to pay out dividends. And you know, that game only goes on so long. So you have to be careful with the companies that you invest in to get your dividend stock, to get your dividend payment. But let's say that you need $3,000 a month and your portfolio is large enough that you can generate $3,000 a month. That would be $36,000 a year. If you had a portfolio of $1 million worth of dividend stocks, could you meet that number? Could you do 3.6% from that, $36,000 a year, $3,000 a month? It's in the realm of reason. This isn't financial advice. I don't know your situation. I'm certainly not giving any investment advice, but the nice thing is if you can live off of the dividends, first, high quality companies tend to raise the rate of their dividends at a rate faster than inflation. Not every year, but over an investment cycle, 7 to 10 years. So if you're spending $3,000 a month, well, 5 years from now, you might be spending $3,500 a month. And hopefully, if you've chosen your companies well, not only has the stock price remained stable or gone up, but the dividends that they pay have also gone up and at a rate faster than inflation. So while inflation might have said you need $3,500 a month, maybe your dividends are paying you $3,600 a month. So they're beating inflation. So that's the first tool. Now it's not without risk, and it's not for the faint of heart, because dividend-paying companies, you know, you own the stock, and stocks are volatile. That's not a bug of the stock market. That's a feature of the stock market. So, you know, if that was a third of your portfolio, is that unreasonable for somebody to have? It's within the realm of reason. Again, this isn't financial advice. If this is 100% of your portfolio, that's a lot of volatility for somebody. So I want you to be careful. Okay, the next one is bonds. Having stable, secure bonds that are going to mature in 6 months, 12 months, 18 months, 24 months. You know, if you own a bond, a bond that's going to get paid off in 30 years, there's still a lot of risk in that. But if you get a stable, secure bond from a high quality company that is the type of company that, you know, are they going to be around? They're a market leader today. Are they going to be around in 50 years to pay back that bond? Nobody knows. But are they going to be around in 2 years? Boy, the world would have to really go poorly for them to be in a position where they don't. So that's what I mean by stable, secure bonds, where there's absolutely zero doubt in your mind that you're going to get paid back that money. And right now, those bonds are paying a higher rate than they have for a long, long time. So stable, secure bonds, and instead of thinking of your portfolio maybe as, you know, 60% stocks, 40% bonds, half stocks, half bonds. A lot of people think in percentages. When it comes to your bonds, I want you to think, how many years worth of cash flow expenses do I have? So in my example, we're spending $3,000 a month, $36,000 a year. That has to come from a source other than Social Security, a pension, rental income, things like that, right? So $36,000. So if I have 3 years worth of stocks, what would that be? That'd be $108,000. Let's call it $110,000. And 3 years is a short period of time. Now, recently, when the stock market's gone down, it's bounced back pretty quickly, but that's not always the case. 3 years is better than no years. I think 5 years is better than 3 years. I think 7 years is a good goal to shoot for. Again, not financial advice, but I think it's a good goal to shoot for. So I said that there were 3 tools, and the last tool is the one that takes the most risk out of your portfolio. But before I get there, I want to share with you a bonus. And that is, it's one thing to have an investment, it's one thing to have a dividend paying stock, it's one thing to have bonds, and it's another thing to have those liquid and ready to be traded. So, for instance, a bank CD, you might have your money tied up for 2, 3, 5 years, and there's big penalties to access that money. So before I get to the last tool, yes, it's nice to have the right tool, but it's also important that that tool is liquid and you can get your hands onto it. Okay, now on to the last one, which is the least risky of all these tools. Doesn't pay much, but it's the least risky, and that is cash. The old adage that cash is king. If you had 3, 5, 7 years worth of living expenses in cash, you're likely not going to be beating inflation with that money, but it also takes the risk out of you being a forced seller in a down market. So if you think that you might succumb to the pressures of the emotional pressure if the market's down 30, 40, 50%, which could happen, don't write that off. These types of things happen much more often than any of us think. Certainly a 10 or 20% correction in the stock market is just it happens. It happens frequently. 30, 40, 50% downturns in the market don't happen as often, but they can happen. So if the alternative is you're going to blow out of the market, if the stocks are down 30, 40, 50%, having enough cash in your portfolio so you don't have to sell something that's down can give you peace of mind. And for some of us, myself included, it can also completely change your mindset on how you look at downturns. For instance, for me, I like to have at least 10% of my portfolio personally. This isn't financial advice for you, but in cash, even while I'm working, because if the market is down, it allows me to buy something at a low price without having to sell something else that's also at a low price. It allows me to take advantage of bargains. And now all of a sudden 20% market downturns don't feel so scary for me. So I think cash is king for a lot of us, but the question is how much cash. And for that, I encourage you to work with a fiduciary financial advisor, somebody that knows you and your situation to help you with that. And if you found this video helpful, I know you're going to find this video helpful here, which kind of dives into, what is the average income for retirees in America, to kind of show how do you compare. Not that comparing is important, but it's kind of a benchmark. What is the average income for retirees in America? Thanks for watching this video. I'll see you in that one. Bye-bye.